April 1999, Yahoo paid $5.7 billion for a company that would be completely shut down within 3 years. Not acquired and integrated, not restructured. Shut down. $5.7 billion became zero. The company was called Broadcast.com, and it made one man a billionaire while destroying billions in shareholder value for another. This is the story of perfect timing, meeting terrible timing, of being right about the future but wrong about the present, and of how the biggest exit in internet history became one of the most forgotten failures. Because everyone remembers Mark Cuban got rich, nobody remembers what he was selling. The year is 1995. Mark Cuban is sitting in his apartment in Dallas, trying to listen to an Indiana University basketball game online. He's not a student anymore. He's a successful entrepreneur who sold his first company. He's got money, he's got time, and he's got a problem. The audio stream keeps cutting out. The quality is terrible. The delay makes the game almost unwatchable. But the fact that it exists at all, that he can listen to a basketball game happening hundreds of miles away through his computer, feels like the future. Cuban calls his friend Todd Wagner. They'd met at Indiana. Wagner is a lawyer, smart guy. They start talking about what streaming audio could become. Here's the insight they had in 1995. The internet was going to replace broadcasting. Radio, television, sports, news, entertainment. All of it would eventually stream through the internet instead of through airwaves. They weren't wrong about this. They were exactly right. But in 1995, almost nobody had the bandwidth to make streaming work well. Most people were on dial-up modems. Streaming audio was choppy. Streaming video was basically impossible for consumers. Cuban and Wagner didn't care. They saw where the technology was heading. They founded AudioNet in 1995. The concept was simple. Aggregate audio content and stream it online. Radio stations, sporting events, talk shows. Anything that could be broadcast could be streamed. The early content was eclectic. They streamed local radio stations, college football games, political events. By 1996, they were streaming Victoria's Secret fashion show, which crashed their servers when too many people tried to watch simultaneously. That crash was actually good news. It proved demand existed. In 1998, they rebranded as Broadcast.com and went public. The stock opened at $18 a share and closed the first day at $62. The market capitalization hit $200 million on day one, and they were just getting started. Here's what made Broadcast.com compelling to investors in 1998. They had technology that actually worked. You could go to their website and listen to hundreds of radio stations, watch sports, access news. The quality wasn't perfect, but it functioned. They had content deals. Radio stations wanted to stream online. Sports teams saw value in reaching broader audiences. Media companies were experimenting with internet distribution. They had traffic. Millions of people were visiting the site monthly. Usage was growing. And most importantly, they had a narrative that aligned perfectly with where the market was going. Streaming media was inevitable. Broadcast.com was the leader. Therefore, Broadcast.com would dominate the future of broadcasting. The logic was airtight. The only question was timing. Let's talk about what Broadcast.com actually was in 1998. Most of their content was audio. Radio station streams, sports radio, talk shows. This made sense because audio files are smaller than video files. They were easier to stream on 1998 internet connections. Video content existed, but the experience was painful. Tiny screens, low resolution, constant buffering. You could technically watch a video, but it wasn't enjoyable, because there was no alternative. If you wanted to listen to a radio station from another city, Broadcast.com was often the only option. If you wanted to watch a sporting event that wasn't on television in your area, streaming was your only choice. Broadcast.com wasn't competing on quality. They were competing on access. This is important. The value proposition wasn't, "We're better than TV." It was, "We can give you things TV can't give you." The business model was advertising, free content supported by ads, standard media economics applied to the internet. Here's the problem with that model in 1998. Internet advertising rates were much lower than television advertising rates. Streaming required expensive servers and bandwidth. Content licensing required real money. Sports rights, radio deals, news agreements. The unit economics were challenging. Each stream cost money to deliver. The advertising revenue per stream was minimal. Scale was supposed to solve this, but scale also increased costs proportionally. They were burning cash, not at pets.com or boo.com levels, but steadily. The bet was that bandwidth would get cheaper, advertising rates would increase, and scale would create network effects that made the economics work. That bet required time. By late 1998, Broadcast.com was a public company with quarterly earnings pressure. The stock had run up based on growth expectations. Analysts wanted to see revenue growth, user growth, and a path to profitability. Cuban and Wagner saw the landscape clearly. They'd built something real. They'd proven the concept. They'd established market leadership. But they also understood something most founders didn't want to admit. The infrastructure wasn't ready. Broadband adoption was still years away. The advertising market for internet streaming was immature. The competition was about to get intense as bigger companies noticed the space. They could keep building, keep raising money, keep fighting, or they could sell. In early 1999, Yahoo came calling. Yahoo in 1999 was the king of the internet, the most visited website in the world, a market capitalization approaching $100 billion. The company that defined what being an internet giant meant. But Yahoo had a problem. They were fundamentally a directory, a portal, a place people started their internet session before going somewhere else. They needed content that kept people on Yahoo. Sticky content, media content. Yahoo had tried building streaming capabilities internally. It wasn't working well. They needed expertise, technology, and existing content relationships. Broadcast.com had all three. The negotiation started in March 1999. Yahoo made an initial offer. Cuban and Wagner countered. Other potential buyers entered the conversation. Microsoft, AOL, others who saw the strategic value. The price kept rising. Here's what was happening in the background. The stock market in early 1999 was insane. Internet stocks were doubling, tripling in value, with no connection to fundamentals. Yahoo's stock was trading at absurd multiples. Yahoo wasn't offering cash. They were offering stock. When Yahoo offered $5.7 billion for Broadcast.com in April 1999, they weren't writing a check. They were issuing Yahoo shares. For Cuban and Wagner, this created an interesting situation. They could accept Yahoo stock worth $5.7 billion at current prices. But Yahoo stock was wildly overvalued by any traditional metric. The smart move was obvious. Accept the deal. Sell the Yahoo stock immediately. The deal closed on July 20th, 1999. Cuban received approximately $2 billion worth of Yahoo stock. Wagner received approximately $1 billion. Most founders in similar situations hold the acquirer's stock. They believe in the combined vision. They see upside. They want to stay involved. Cuban sold. Not all of it immediately. SEC rules prevented that. But he sold aggressively and used sophisticated hedging strategies to protect his position against Yahoo's stock decline. By the time the dot-com crash hit in 2000, Cuban had converted most of his Yahoo stock into cash and other assets. He became a billionaire. He bought the Dallas Mavericks. He became a celebrity investor and Shark Tank personality. The exit was perfect. The timing was immaculate. The execution was flawless. Now let's talk about what Yahoo bought for $5.7 billion. Broadcast.com in 1999 had about 300 employees. They were streaming content from approximately 400 radio stations and various video sources. Traffic was solid, but not spectacular by internet standards. Annual revenue was about $22 million. Let that sink in. Yahoo paid $5.7 billion for a company generating $22 million in annual revenue. That's a multiple of about 250 times revenue. Not earnings. Revenue. The pitch was synergy. Yahoo would integrate Broadcast.com into Yahoo's platform. Millions of Yahoo users would now have access to streaming content. Advertising rates would improve with Yahoo's brand and reach. The combined entity would dominate internet media. The integration began in late 1999. Yahoo started promoting streaming content across their portal. Broadcast.com technology became Yahoo Broadcast. Initial results looked promising. Traffic increased. More content providers signed deals. The vision seemed to be working. Then reality started asserting itself. Bandwidth costs remained high. Most users still had slow connections that made video streaming impractical. The advertising market for streaming content didn't develop as quickly as projected. Competition increased. Real Networks, Microsoft's Windows Media, others were building similar capabilities. The technology advantage Broadcast.com had was disappearing. By 2001, Yahoo was facing different problems. The dot-com crash had destroyed their stock price. The company needed to cut costs aggressively. Unprofitable divisions were being shut down or scaled back. Yahoo Broadcast was losing money. The path to profitability was unclear. The strategic rationale that justified $5.7 billion was evaporating. In 2002, Yahoo quietly shut down most of the Yahoo Broadcast services. Some technology was retained and integrated into other products. But the standalone streaming business that had been Broadcast.com ceased to exist. The content deals were terminated. The employees were laid off or reassigned. The brand disappeared. $5.7 billion bought Yahoo roughly 3 years of operation and some technology that was eventually replaced. The financial analysis is even worse. If you calculate the total cost, including ongoing losses during those 3 years, Yahoo probably spent over $6 billion for essentially nothing. This is one of the worst acquisitions in internet history by financial return. But it's rarely discussed that way because the narrative got complicated. Here's why the Broadcast.com story doesn't get told like other dot-com failures. The founders won, spectacularly. Mark Cuban became a billionaire and a celebrity. He's seen as smart, savvy, someone who perfectly timed the market. Todd Wagner also did extremely well. When founders win, the story of their company dying becomes less interesting. We focus on the success, not the failure. Yahoo lost. But Yahoo was also simultaneously making many other questionable decisions and acquisitions. Broadcast.com was just one expensive mistake among several. And the biggest factor, Cuban was right about the future. Streaming did become dominant. YouTube launched in 2005 and proved the model. Netflix transformed from DVDs to streaming. Spotify made streaming the primary way people consume music. Twitch made streaming a massive industry for gaming. Every thesis that Broadcast.com was built on turned out to be correct. Cuban just sold the company before having to prove it himself. He saw the vision, built something valuable enough to sell, and exited before the hard part. This creates a strange legacy. Was Broadcast.com a success or a failure? For the founders, complete success. They built something, sold it for billions, and captured that value. For Yahoo, total failure. They overpaid massively and got nothing lasting in return. For the vision, validated. Streaming became everything Cuban predicted. For the timing, everything. The difference between being a billionaire and being bankrupt. This is different from most dot-com failures we discuss. Usually everyone loses. The founders, the investors, the employees, the acquirers. Broadcast.com shows you can be right about the technology, right about the market, right about the future, and still have the company completely fail, while the founders walk away wealthy. The question is whether that's success or just excellent timing. The Broadcast.com story teaches something uncomfortable about entrepreneurship. Being right isn't enough. Being early is often the same as being wrong, and knowing when to exit matters more than knowing how to build. Cuban and Wagner built real technology that solved real problems. They aggregated content, created a platform, attracted users. The fundamentals were sound, but they also recognized something crucial. The infrastructure wasn't ready for their vision to become profitable at scale. Broadband adoption in 1999 was minimal. Advertising markets were immature. Content costs were high. The unit economics didn't work yet. They could see that these problems would eventually be solved. But eventually could mean 3 years or 10 years. And they couldn't burn cash for 10 years, waiting for the market to catch up. So they sold to someone who had enough money and patience to wait. Except Yahoo didn't have patience. They had quarterly earnings pressure and a stock price to maintain. Imagine Cuban and Wagner had turned down Yahoo's offer, kept building, raised more money, fought through the dot-com crash. Maybe they build YouTube before YouTube exists. Maybe they become Netflix. Maybe they create the streaming platform that dominates. Or maybe they run out of money in 2001 when funding dried up. Maybe they shut down like thousands of other dot-com companies. Maybe they lose everything. We don't know, because they didn't take that risk. They took the certain billions over the uncertain future. And this is the sophisticated insight most people miss. Cuban understood that being right about the long-term vision doesn't guarantee being able to capture the long-term value. Timing, luck, market conditions, funding availability, competition, technology adoption. All these factors determine whether a company with the right vision actually succeeds. Cuban controlled what he could control. He built something valuable. He created options. And when someone offered him generational wealth for those options, he took it. The Yahoo acquisition price was absurd. Everyone knew it at the time. But Cuban's job wasn't to worry about whether Yahoo was overpaying. His job was to maximize value for himself and his shareholders. He did that perfectly. Yahoo's job was to make smart acquisitions that created long-term value. They failed spectacularly. This creates an interesting tension in startup culture. We celebrate the founders who sell for billions. We criticize the companies that overpay for acquisitions. But these are often the same transaction. Someone's perfect exit is someone else's terrible investment. $5.7 billion for a company with $22 million in revenue. The number sounds crazy because it is crazy. But in the context of 1999, it made a certain kind of sense. Yahoo was worth $100 billion on paper. They were competing with AOL and Microsoft for internet dominance. Streaming felt like the future. $5 billion was expensive, but not existentially risky. Except the paper value was an illusion. The stock prices were disconnected from reality. The multiples didn't reflect sustainable business models. When the market corrected, the illusion disappeared. And what remained was the reality. Yahoo had traded real stock for technology that didn't matter and a vision they couldn't monetize. Broadcast.com wasn't forgotten because it failed. It was forgotten because the failure was overshadowed by the success of its founders. We remember Mark Cuban. We forget what made him rich. And maybe that's the real lesson. In the startup game, what matters isn't whether your company lives forever. It's whether you capture value while the opportunity exists. Cuban saw the window. He jumped through it. The window closed behind him. And on the other side was $1 billion and a basketball team.